Hello dear 9A level students. Today our video will be about the last part of our chapter related of sources of finance, chapter 25, the first chapter of accounting unit. As you can remember, we've covered internal source of finance, which was about a company finding finance internally without any external source. And then we started external sources of finance, which included finding source capital from an external source. And we couldn't finish all of it. We have a last part, which is in total we have 2, 4, 6, 8, 10, 11 sources of finance. Now we're going to cover the last 5 today. The first one is debentures. If you're a debenture holder, you are giving finance to the company by buying these debentures of the company, and at the end you will get your money back with an interest. So you're actually a lender for the company, but you are not an owner. You won't have any voting rights or you won't have any shares. By this way, the company has an opportunity to get a long-term source of finance and pay in a future date. The other one is hire purchase, HP. Hire purchase is a common way of getting finance for buying vehicles and equipment, such as cars, equipment, machinery. So this is our vehicles. In an HP type of finance, you have to make a down payment, and the rest of the payment is done by installments. It's very similar to an individual going and buying a car, where they usually give their old car as a down payment, or they give a small amount of money of it, and then the rest they pay in installments for 3 years, 5 years. It depends on the agreement. And here, you don't own this vehicle or equipment or machinery until the last installment has been paid. When it's paid, and then you become the owner. It's again similar to owning a car. When you pay in installments, the car does not belong to you until you finish your last amount of installment, whoever you are credible to. If it's a bank, then the car will belong to a bank. Similar here in an HP, the vehicle or the machine will belong to the lender until you finish. This is actually, in HP, we actually have a slight higher interest payment than the other types of credits. That is why it is not very strict legally when they give you this credit. So you will have to pay, so you'll be in a risky group, you will have to pay higher interest. This is a common rule we talked about. As more as we see the risk, the higher the interest will be. So more risky, higher interest. Less risky, lower interest. And the other type is a share capital. So limited companies have a chance to sell shares to get funding. In return, these people or companies will become shareholders. That means they will become owners of a company. They will have a right for dividend, which is the profits made by the company. They will have a share of the profit. They will have voting rights, etc. Of course, depending on the number of and percentage of shares they have, they will have higher rights in the company. So in a share capital, you can sell shares to get company funding. But don't forget the difference from share capital from loan capital, which is lending money, is that here you will not pay this back, you will not pay interest, but you will sell your ownership of the company, and at the end there's a chance that you may lose ownership to outsiders. Okay, the last two, venture capitalists. Venture capitalists are companies which invest in small and risky businesses, usually in small and risky businesses. And the reason here is that normally banks and more formal institutions don't like to invest, don't like to lend to the small and risky businesses. because there's a chance they may not be able to pay it back. So venture capitalists are specialized for investing in these companies. Of course, in return, they usually ask for ownership. They usually ask for shares. They usually ask for intervening in the running and administration of the company. So this is that type of funding. And the last one is crowdfunding. Crowdfunding is a new and popular way of finding resource. It involves using more technology, which means that you can post online that you need funding. It can be for a specific project, for saving the environment, for making a new building. And the crowd, which means people, individuals, or companies may be interested in investing, and you can collect the money online. So you exclude all the banks and other financial institutions, and your lenders or your investors are from the crowd. They come from the crowd. And in return, you usually give them ownership, or you may have to pay back their money. Okay, to sum up, this 5 of them we talked today and the 6 of them we talked previously altogether make up external sources of finance for a business. And so as we finish the chapter, we will answer the questions of external sources of finance, which are on page 216, 217. And this will be the last chapter we will cover probably for this academic term. See you. Bye-bye.